Cathie Wood of Ark Investment Management has just made a really entertaining video in which she takes a bit of a pot shot at passive funds, particularly the ones which track broad market indices. So in this video we'll go through some of her points and we'll look at her funds to see why they've been so successful. And we'll take a bit of a broader context to see a historic example which has certain similarities to what we're seeing today. And remember, if you do want to stay informed about what's going on in markets and learn more about economics and how the two interact, then why not sign up for our free weekly market roundup? You'll find a link in the description below and above me. So let's look at Ark Invest and Catherine Wood's comments about passive indices in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Having active managers whose job it is to beat benchmarks come out and say those benchmarks are lousy is now becoming a regular occurrence. So expect this response to be part of a longer running thread, which you might call something like passive attack. So here beside me is Catherine Wood, who's the founder and chief investment officer at Ark Investment Management. Now she produces a whole series of YouTube videos which are incredibly entertaining. If you haven't already seen them, I strongly recommend you take a look. But in this Twitter thread, but also some recent interviews, she's been taking quite a hard swipe at some passive benchmark tracking funds. And her point is that the S&P 500 and the NASDAQ are full of many companies which aren't particularly good. She calls these value traps. But she's saying that they're cheap for a reason, and she thinks they'll carry on being cheap pretty much forever. And her investment thesis is that those companies will simply be swept aside by the companies in which she invests due to innovation and disruption. And she goes on to say that passive and benchmark sensitive investing is contributing to the most massive misallocation of capital in history. And that's because benchmarks are weighted by market capitalization. You tend to buy more of companies which are large, and they're large because they were successful in the past. But then she pushes that argument perhaps a little bit too far by saying that that would put the US at a competitive disadvantage to countries like China. This kind of reminds me of a report by AllianceBernstein in which they said that passive investing was almost like socialism. But embedded in this Twitter thread is an absolutely hilarious video in which they take a swipe at passive investing. But they do it in a genre which you must have seen in hundreds of corporate videos, where you start off with this kind of open plan office with a kind of smooth voiceover saying, "Are you an investor looking for long-term capital appreciation but worried about short-term volatility associated with innovative companies? Well, you're not alone. Many investors appear to be afraid of companies that offer newer, faster, cheaper and creative products and services. Now you can avoid these innovative companies. How? Ask your advisor today if investing in a traditional broad-based index is right for you." Well, actually that's not quite true, because broad-based indices will also include these innovative companies. And that reminds me of something Jack Bogle used to say, which is if you can't find the needle in a haystack, which she thinks she can, then just buy the whole haystack. And then the video goes on to reiterate the fact that a broad-based index is market cap weighted, and so it weights past success. And it makes fun of companies which generate predictable cash flows, because that's really boring, right? Because in this new world, we're not going to need anywhere to live. We won't need physical goods to be transported, because at that point, we'll have uploaded ourselves to the cloud. But of course, I'm being facetious. If you do want to look at the report, it's free to download on their website, and it's really interesting. And by any measure, the performance of ARK funds has been spectacular. What we have at the bottom of this graph are the sectors of exchange traded fund, as classified by ETF-DB. And each of these black dots on the graph tell you what the return was on a single fund. And I've highlighted ARK funds with this red ring, just so that you can compare them with other funds in the same category. And you can see that whatever category they go for, they've performed very well. So this is the year-to-date return, and if instead we look over a longer period of time, and this is return over the last 3 years, and some of the ARK funds have now disappeared because they were issued in the last 3 years, but you can still see this very impressive outperformance. Now you can measure the success of an active manager according to how much money they bring through the door, because remember what they actually make is a percentage of their assets under management. And in terms of asset gathering, this has been a spectacular year for Ark. So the green bars you can see here mean that money's flowing into the fund, and the red bars indicate that money's flowing out of the fund. And this is just one of their funds. It's the Ark Innovation Fund, ARKK, and that's had over $7 billion of inflows over the last 3 years. There were fairly steady inflows leading up to 2020, but then in 2020 there was a huge inflow of $5 billion over a 6-month period, and you can probably guess the reason why. Investors tend to chase performance. So if something's performed well recently, money pours into a fund. And Ark funds are no exception. Here are 4 of their funds, all of which have had an incredible performance in 2020 after the March sell-off. But not all of that is due to the stock picking skills of Ark. Some of that performance is going to come from the sectors in which Ark has allocated its capital. So the graph we'll see next is going to be one where we strip away the returns of QQQ, which is the Nasdaq tracking ETF. And now more of that cumulative return that we see is due to the stock picking skills of Ark. That is, after all, what they're being paid to do, to find the needles, which are the outperforming stocks, in the haystack of the benchmark stocks. And the picture that we now see is very different. Funds like Ark Industrial Innovation underperformed the Nasdaq in 2015, for example, and then underperformed again during 2018 and 2019, but then outperformed in 2020. The Ark Next Generation Internet ETF was fairly flat relative to the Nasdaq in 2015. It didn't generate much outperformance. Its alpha was about 0. Then it underperformed in 2019, but it had a spectacular 2020. The Genomic Revolution ETF, again, fairly flat for several years, and then it had a very good 2020. And the Ark Innovation ETF didn't do much until 2017, but had an incredible 2020. Now, Ark puts a huge amount of work into choosing their particular stocks, and one of their favorites is Tesla. I should quickly say before I get slammed in the comments that I love Tesla, I love their products, maybe one day I'll have one, but there's no way you can say that their stock is cheap. And if we look at the ETFs which have the largest percentage holdings of Tesla, you can see 3 of those Ark ETFs are on the list, with the Industrial Innovation ETF having about 11.9%, Innovation and Next Generation Internet have about 10% each. And say we look at the holdings for Ark Innovation ETF, you can see Tesla's top of the list, but what's true of many of these stocks is that their valuations will be very high. So it's hardly surprising that Ark has done so well in 2020, given that it's bought growth, which has done incredibly well during this period. But the question people have to ask themselves is whether growth will always continue to outperform. Value's had a 200-year drawdown, so will it be the case that value companies will never get a bite of the cherry ever again? I don't think so. And although we're clearly moving away from internal combustion engine cars to electric cars, the valuations and the share price movements that we've seen are very clear signs that we're in an EV bubble. And you can see that FT journalists also have a sense of humour. Here Jamie Powell says that this is totally normal price action for the Nasdaq listed company called Arkimoto. And we all remember the recent headlines about Nikola. And the FT here quotes a short report from Hindenburg Research, which says that Nikola had overstated its technology, overpaid insiders, and, most memorably, rolled a truck down a hill to prove its vehicles worked. And I should say that Ark never invested in Nikola. They invest heavily in Tesla. And it's one sign of how crazy valuations have got for EVs that they've started using a new valuation measure. The new measure looks at the value of a company, its enterprise value, divided by something called TAM, or Total Addressable Market. Now that's the amount of revenue you'd get if you had 100% market share. Will any company ever have that? No. But what it does do is divide by a bigger number, so the company doesn't look as expensive. If you're enjoying the video, then please click like, and you can support us on YouTube directly, and you get an incredibly well-designed badge. Now, it's always useful to look back in history and look for similar situations. Things will never be the same twice, but you do get certain similarities. So what I'm going to talk about here is the bicycle mania that happened in the UK around the end of the 19th century. Now, the first ingredient was low interest rates, and this is the Bank of England's bank rate, which had just fallen from 10% in 1866, but then it subsequently oscillated between about 2% and about 5% for many years. And the black line is the interest rate on UK government bonds, which were then called British consols. That also was fairly low relative to history, but again, not as low as it is now. The effect of low interest rates is that people have to move their money into riskier assets. If you can't generate much income with a very safe government bond, you have to take more risk. So all that money is looking for riskier ventures which could potentially give more upside. And the second ingredient is innovation. And that innovation has to be practical. It has to make something that was difficult before become easier. Now here's something that was difficult: riding a penny farthing. Simply getting onto one of these things would have been tricky, but staying on would have been very important. You can probably imagine what would happen if you fell off. Also, notice that there's no bicycle chain here. So if you had to cycle up a hill, that must have been incredibly difficult. And sure enough, there was a huge innovation. This is called the safety bicycle for obvious reasons. It's certainly safer than that penny farthing. And this looks pretty much like a bike that we'd buy today. Notice how we've now got an air-filled tyre so that we get a much more comfortable ride. Ball bearings reduce the friction in the wheel so we don't have to pedal as hard. And at the time there were also new processes for producing weldless steel tubes. And this was groundbreaking. Many people could now buy bicycles and they became incredibly popular. You just had to walk down the street and you'd see people on these bikes. So interest rates were low. There was a visible innovation, and you can probably guess what happened next. If you look at the number of share prices for bicycle companies that were listed in the Birmingham Daily Mail, and I should perhaps mention that my family was some of the metal bashers that lived in Birmingham in the 19th century, and many of these companies then retooled to produce bikes. So there was this explosive growth in the number of companies whose share prices were listed, and that was over the space of about 2 years. And if there had been an Ark Innovation ETF at the time, you can bet it would have bought at least one of these companies. And here's an index that's constructed out of the share prices of these bicycle companies in black, whereas the dashed line is the performance of the broad index. And I'm sure that during this period, people would have been saying, why would you ever buy a broad index? You should just go for these innovative, disruptive bicycle stocks. And again, you can probably guess what happened next. If we extend the graph past the end of the century to 1903, those bicycle shares which had done so well started to underperform. And in fact, they fell back to below the level of the blue chip index as the disruptive stocks started to go bust or were simply assimilated into larger companies through takeovers, and then they simply started tracking the blue chip index. And that's simply because today's disruptive, innovative company becomes tomorrow's blue chip stock. So don't get me wrong, I think Ark has done an incredible job in explaining what they do. I love their reports and also their YouTube videos, but I simply don't think they're going to sweep away the necessity for investing in broad, passive ETFs. As the core of someone's investments, I think they're very difficult to beat. And here we can see 6 of Ark's funds, and this column here is the expense ratio. And remember, you can track one of those defunct broad indices for maybe 0.05%, whereas the charge for these funds on an annual basis is much higher. They're all around 0.75% per year. So although I love their approach to investing, their transparency, their investor education efforts, I simply think that you're paying a lot for these funds. And there's always the danger that you'll confuse two things: passive investing and thematic investing. Is it possible to do theme-based investing with a passive fund? Well, yes, it is. Other funds are available, but here's a whole bunch of passive funds which track certain themes. And as very large asset managers like BlackRock enter this space, perhaps that'll put a downward pressure on fees, even for asset managers like Ark. And the investment performance for some of these passive thematic investment funds has been very impressive. This is the Global Clean Energy Fund from BlackRock, and like many of those Ark funds, it's had an incredible 2020. And although the expense ratio is far from cheap, it's considerably lower than it is for Ark. Although I have to say this kind of blurs the boundary of what is an active and a passive fund. Ultimately, it relies on index providers like S&P Global Indices providing indices like this clean energy index. Here's S&P's description of that index, and what's really nice is that multiple providers of passive funds could track this same index, which would create competition and lower fees. So I think if we do see a compression of fees, a lowering of the cost for us investors, it's going to come primarily in the first instance from passive providers, not active providers like Ark. So I don't think it's helpful for active managers to be slamming passive benchmark-driven investment. If they are very good at their jobs, they should just get on with it and prove that when you pay the very high fees for active management, in most cases, then they're worth that fee. And if you do want to learn more about investing, then a great way to do that would be to join our online community via Patreon. And there'll be a link in the description below me and above me that shows you how to do that. There are all sorts of goodies you get, lots of exclusive content, but also membership of our Slack application where you can talk to me and other members of the community. And as always, thank you for listening.